If someone owns no physical gold or silver today, what risk are they actually taking, Bill?
They risk ending up with zero wealth whatsoever. I mean, gold and silver are your only life jackets or only life rafts. They're the only thing that's going to float when everything collapses. People don't have the knowledge, the skills to survive and live off the land. This is going to be, the financial collapse is going to bring a societal nightmare.
Yeah, I agree with you. And we've had lots of discussions about that. But, confidence is one thing you've always talked to me about. Markets don't collapse overnight. Confidence can.
Global debt has reached an unsustainable ceiling, threatening to spark an unprecedented economic reset that could wipe out paper wealth overnight. Prominent precious metals experts Andy Schectman and Bill Holter forecast that a catastrophic breakdown in the fiat monetary system is now mathematically inevitable. They assert that unbacked paper contracts and overleveraged debt instruments offer zero protection against the coming financial storm. With major private credit markets fracturing and global central banks rapidly losing grip on yield curves, an imminent failure to deliver in physical commodities like silver could trigger a severe systemic panic. Their prediction indicates that when the current financial framework undergoes its unavoidable reboot, holding physical gold and silver will be the sole mechanism for retaining true purchasing power. Consequently, those who own tangible precious metals will essentially operate as private banks in the post-collapse economy, whereas unhedged investors face total wealth destruction. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Are you concerned about what we're beginning to see in private credit? Do you think this could be the catalyst, or is private credit simply another casualty of the broader credit contraction, I guess you could say, that you've been talking about? And I preface this by saying, is it a little bit concerning that we see the head of private credit of both BlackRock and Blackstone, those two entities that have experienced gating and redemptions that they had to gate and block? Is that an early warning sign, should we see, or are the biggest problems still ahead?
Well, obviously the biggest problem is still ahead because it's not collapsed yet. But those two guys leaving as the head of credit of Blackstone, and what was the other one?
BlackRock and Blackstone.
BlackRock, right. I mean, that is, the canary just died. You're not going to get the heads of credit at both, the two biggest firms leave at the same time and say, we're retiring. They've gated investors, meaning investors can't get their money out. It's like Hotel California. They put money in, promised, all kinds of goods, and now they can't even get their money out. And the reason they can't get their money out is people are actually looking at, in particular, the AI companies and the spend outs that they're going to have to do and the amount of capital that's going to be needed. That capital doesn't exist. They're never going to be able to get to the finish line. And they, credit accountants, whatever you want to call them, they look at this and they know the ending. And that's what these two guys saw. They know the ending. So they're jumping ship ahead of time. Whether it's AI that does it, whether it's the yen carry trade, or whether it's a failure to deliver in a commodity, most likely silver. Again, mathematically, the debt cannot be serviced unless the debt levels increase from already the highest levels ever. It's a mathematical equation where the only answer, every door you walk through, is complete and total financial collapse, which in today's world, because people can't hunt, or they don't know how to hunt, they don't know how to fish, they don't know how to survive without going to their local Walmart or Circle K 3 or 4 times a week. People don't have the knowledge, the skills to survive and live off the land. This is going to be, the financial collapse is going to bring a societal nightmare.
Yeah, I agree with you. And we've had lots of discussions about that. But, confidence is one thing you've always talked to me about. Markets don't collapse overnight. Confidence can. I'm not going to ask you what that event is, because who knows what the event is. We've already seen it on a central bank scale, as you mentioned, with the confiscating of the Rush treasuries, the shenanigans with being kicked out of SWIFT, and all of the things that we've well documented. But can central banks restore confidence once it's gone, do you think?
The answer to that is eventually, but that's going to be a long time. Confidence will be restored in the countries that have amassed gold, because gold is understood to be it's a non-political asset. It is money itself. It can't default. When you have credit defaulting, what happens to the banks that hold large treasury positions as their reserves? I mean, I lived in Costa Rica for 5 years, and I realized toward the end, when the dollar goes, that country's gone because all of their reserves are in U.S. treasuries. So what's going to happen to that central bank? And that's the problem, is that there's no real foundation to the financial markets today. The foundation that used to be gold, and to a lesser extent silver, is now U.S. treasuries, European Union bonds, Japanese bonds, British bonds, et cetera, et cetera. They're paper. They're contracts, and contracts are made to be broken. And there is no contract with gold. There is no contract with silver.
And that's
they
right.
have
No
value.
counterparty risk.
They are.
If someone owns no physical gold or silver today, what risk are they actually taking?
They risk ending up with zero wealth whatsoever. I mean, gold and silver are your only life jackets or only life rafts. They're the only thing that's going to float when everything collapses. Warren Buffett talks about derivatives being weapons of mass financial destruction, and the only time you find out who's swimming naked is when the tide goes out. Well, when the tide goes out, if you're sitting on gold or you're sitting on silver, when the system does reboot, you're going to be among that small population, 0.5% of the world, that actually has wealth, because gold and silver cannot bankrupt in a world that is currently bankrupting. I mean, mathematically, you can see we're in the process of it. And Andy, early on in doing precious metals, I would ask new people, do you think the U.S. government is broke? And 95% of the people would say, well, yeah, of course they're broke, but it doesn't matter. And the bottom line is, you're right, it doesn't matter until it matters. But when it matters, if you don't have gold, if you don't have silver, you have no wealth. I mean, you could have land that will easily be taxed away from you. You could have a house. You're not going to be able to pay any mortgages. Things are going to stop, whether it be for 2 weeks, 2 months, God forbid, 6 months or more. And the system will eventually reboot, and it'll look a lot different. There's one of your resets. But when it does reboot, if you don't have gold or silver, you're not going to have capital. And if you do have gold or silver, you're essentially going to be a private bank.
Cracks are multiplying across private credit markets as institutional redemptions get gated and top industry executives abruptly resign. Unrealistic capital demands from overhyped sectors like artificial intelligence are exposing a massive shortfall in liquidity. At the same time, rising interest rates are systematically popping historic asset bubbles built on decades of cheap credit. Central authorities are visibly losing control over monetary policy. Whenever official rate reductions fail to push market yields down, investor panic escalates. Predictions suggest that a third divergence between central bank policy and rising bond yields will unleash a massive sell-off of government treasuries. As confidence in fiat stability evaporates, sovereign debt will no longer serve as a safe haven. The impending market reset will strip value from unbacked paper obligations, leaving only tangible assets intact. Now, let's get back to the interview.
We also are seeing something that, to me, is interesting. You can comment on all of this. And it was only 1 day's worth of trading, or two, so 2 days don't make a trend. But we saw interest rates, which, by the way, went up after the Fed meeting. Normally they rise in line with the Fed meeting. This time they went against the Fed. The Fed didn't raise, and 30-year did go higher. But as the 30-year yield went higher, the dollar went lower. Now, normally we see them go in the same direction. As rates are going higher, there's greater demand for the dollar. You see the dollar go up. Went the other way. Speaks to confidence, speaks to questioning of our fiscal and monetary path and if it is actually sustainable. So why don't you explain your feelings on the yen carry trade, how it's been a piggy bank for the world for so long, and now it appears to be ending. And what could that mean in Bill Holter speak to the market moving forward?
There's a couple things there. First off, we're lied to about everything. So them telling Besant saying that they were selling euros and buying yen, but yet the dollar went down, that makes 0 sense, which tells me they were selling dollars and buying yen. I mean, you saw almost a full % drop on the dollar from Thursday close to the weekend. So that operation, it's clear that it was not euros that were sold, it was dollars. Interest rates going higher, and that's the biggest thing right now worldwide, interest rates are going higher onto a financial system that's more leveraged than it's ever been in the history of history under any metric you can imagine. Higher interest rates pop bubbles. Every bubble since 1982, when interest rates peaked and started coming down, every bubble popped when interest rates started going up. You saw the stock market crash in 87. You saw the crisis in European bonds in 93. You saw long-term capital in 98. The dot-com boom, the 2008-2009 great financial crisis. Every time interest rates go up, the bubbles get popped. Those bubbles, when you hear the term bubble, understand that a bubble is created by borrowed money buying assets. And it's when that credit gets pulled that the assets turn in price and start coming down because there's forced selling. The interesting thing, and I spoke about this probably better than 3 years ago, and we've already seen 2 instances, and I'm saying that the third instance will be the final one. The Federal Reserve cut rates, or started cutting rates 2.5 years, 3 years ago. They cut rates 0.5%, but market rates went up 0.5%. They did it again in this last cycle of a year and a half ago when they were cutting. They cut rates roughly 0.5%, and rates went up a little bit more than 0.5%. So market rates are going the opposite direction of what the Fed is doing, which if you look at that, it's like they're losing control of the yield curve. And I think the third time will be the charm. The next time the Fed starts to cut rates and interest rates go higher, the marketplace is going to look at it and start dumping treasuries because they understand that the central bank has lost control, and confidence at the same time is being broken on a daily basis by the U.S. And that really started back in October of 22 when the Biden administration confiscated $300 billion worth of Russian treasury reserves, U.S. treasuries that they were holding, but again, not really holding because the U.S. Treasury basically locked them out and took the treasuries. That goes to the rule of law. That goes to confidence of other countries thinking, hey, if they can do this to Russia, they can easily do it to us. So they're at the end of their rope, and that rope was interest rates coming down from 15% all the way to 0. And they talked about or tried to implement negative interest rates, which would have been a disaster. But you can't go any further below 0. Now rates have turned. That great 40-year or close to 40-year drop in interest rates is behind us. Now we're going to be looking at higher interest rates upon a world that has never been as leveraged as it is today, which means it's going to be harder to, you're not going to be able to refinance. It's harder on the housing industry. I mean, a 7% mortgage versus a 3.5% mortgage, what you might have been able to afford $1 million house before, but now it's only $600,000. So the fact that interest rates are higher cuts the legs out of borrowed money being able to push the prices higher because the affordability factor of higher interest rates.
Decades of declining interest rates fueled an artificial surge in real estate valuations, equities, and sovereign debt instruments. However, the secular reversal toward higher borrowing costs is now severing the legs from leveraged investments and mortgage affordability. Geopolitical shifts, highlighted by the freezing and confiscation of foreign exchange reserves, have permanently shattered international trust in Western debt contracts and eroded the rule of law. When conventional paper markets freeze, the lack of fundamental self-sufficiency skills among the general population will turn an economic halt into a severe societal nightmare. Central bank intervention will prove powerless to restore credibility once fiat currency debasement accelerates out of control. Predictions reveal that an inevitable delivery crisis in physical commodity markets, coupled with an uncontrollable yield curve, will force a global monetary reset. Paper contracts, government bonds, and fiat reserves will face severe default, while gold and silver carrying zero counterparty risk will remain completely immune. As modern financial infrastructure crumbles under unpayable debt liabilities, the tiny fraction of the global population holding physical precious metals will navigate the economic reboot with intact capital and unprecedented financial leverage. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.